Tech giant's $400 billion AI bet. Returns on investment is the key issue. Extent of monetization will determine the future of many big companies. Author Ashok Neelkantan AS. Continued from Part 1. Google Cloud offers customers everything from computing time on a wide range of AI chips to access to a fully managed AI development platform called Vertex AI, with Google Cloud passing milestones of more than $10 billion in revenue and more than $1 billion in operating income in the second quarter. NVIDIA occupies a unique position as the infrastructure provider, enabling all competitors. NVIDIA has experienced meteoric growth, becoming the world's most valuable company in 2024, with forecasts predicting triple-digit sales growth and revenues reaching an astonishing $129 billion next year, fueled by surging demand for its AI-focused computing platforms. Healthcare shows early promise as AI's pattern-matching capabilities align naturally with diagnostic tasks and drug discovery. Financial services have quietly deployed AI for algorithmic trading and risk assessment, though opacity concerns persist around credit decisions and fraud detection. Legal services face dramatic upheaval as junior associate work, document review and research, precisely matches AI capabilities. Defense applications proceed largely behind classification barriers, but available evidence suggests military establishments view AI as potentially decisive in future conflicts. The employment impact remains ambiguous. The Magnificent Seven saw gains of 63% in 2024, following a remarkable 75% increase the year before, with the combined profits of the Magnificent Seven surpassing those of most countries' entire stock markets. Despite this value creation, workforce patterns show conflicting signals. Microsoft announced layoffs of approximately 15,000 workers in 2025, even as profits soared, positioning the cuts as organizational reimagining for the AI era. Unemployment rates in major economies remain near historic lows, suggesting AI has not yet triggered mass displacement. This may reflect implementation delays, the gap between technological capability and actual deployment across millions of workplaces, or indicate that AI augments rather than replaces human workers, at least in the medium term. Morgan's Michael Semblest calls the Magnificent Seven's AI investments the stock market bet of the century, with Semblest believing these companies have until late 2026 to demonstrate that their AI spending isn't merely expensive science projects. Market concentration presents systemic risk. By August 2025, the Magnificent Seven's unparalleled market capitalization reached nearly $19.4 trillion, representing a significant portion of the S&P 500, driving much of its earnings growth. Without this group, the aggregate earnings per share of the S&P 500 would have contracted in 2023 instead of growing. The competitive dynamics increasingly resemble a corporate Cold War. In the spring of 2024, Beijing ratcheted up pressure on tech executives, with one leading Chinese AI company telling the Wall Street Journal it fielded calls from 10 different government agencies in a single month urging action on native AI models. The subsequent emergence of China's DeepSeek, producing competitive models at drastically lower costs, transformed corporate competition into a broader technological sovereignty contest. Historical patterns suggest caution. According to the report, this is a cycle that happens every 20 years or so: the PC era, the Internet era including the shift to mobile and cloud, and now AI and automation. The dot-com era demonstrated that transformative technologies can coexist with speculative X's. Some companies, Amazon, Google, emerged to reshape entire industries. Others, Pets.com, Web1, collapsed into deserved obscurity. The infrastructure requirements alone create unprecedented dependencies. The energy demands of the Magnificent Seven are rivaling those of small countries, which means that they will have to invest in order to turn into sustainable energy companies, with limitless clean energy supply being a critical success factor. Microsoft's capital expenditure trajectory illustrates the scale. Total capex for the fourth quarter of 2025 was $24.2 billion, up 27% year-over-year, with CFO Amy Hood noting that capex will continue to grow, though the 2025-2026 shift is expected to be slower than between 2024-2025. The company currently has $368 billion of contracted backlog across Azure and the rest of Microsoft Cloud, suggesting spending correlates to booked business rather than pure speculation. The verdict remains uncertain. As the AI trend matures into its third year, analysts anticipate a shift in focus from building AI capabilities to deploying and monetizing AI products, with Goldman Sachs referring to this transition as Phase 3 of the AI evolution. The next 18 months will determine whether today's spending represents prescient investment in transformative technology or the peak of an extraordinarily expensive bubble. For shareholders, workers, and the broader economy, the Magnificent Seven's $400 billion annual wager has moved beyond theoretical possibility into existential necessity.